Hey guys, it's Big Mike, and like always, I'd like to thank you for being here today. Today I'd like to welcome back Peter Davies from Jigsaw Trading, here to talk about trading the chop. So some of the bullet points that Pete wants to cover today include the introduction to Jigsaw's trading tools that we'll be using today, benefits of trading the summer chop, range trading versus trend trading, identifying trade locations, refining entries, and managing those trades. Pete has asked everybody to hold the questions until the end of the presentation, so once he's done, you can ask your questions in the questions box, and we'll do our best to get everybody's questions answered today. The webinar is being recorded like always. I'll post the recording sometime tomorrow on our YouTube channel. If you are watching the recording at a later date and you like it, give us a thumbs up. It does help us out. All right, with that, I'm going to turn things over to Pete right now. And okay, Pete, you should have the option to share your screen.
On my screen, second. Okay, you should have that now. Have you got that, Mike?
Yep, we've got it. Looks good. Thanks, Pete.
Okay, so as mentioned in the webinar invite, Jigsaw is a BMT sponsor, and as a sponsor we get invited to present a promotional webinar to the members. So what that means is I can show you around the Jigsaw tools a little bit more than in a regular educational webinar. Now, we've had the opportunity to do this since the start of the year, but I'm not a big fan of pure sales pitches. So with the summer coming up, I decided to use this opportunity to discuss the tools in the context of the summertime chop. Now, as we discuss this, it will probably become apparent that the tools aren't mandatory for trading the summertime chop. So we're going to discuss the pros and cons of trading the chop, and also looking at what skills you'll develop during a summer of chop that will actually help you for the rest of the year. And we'll also discuss how the Jigsaw tools can help and specific things to look at to get you in and out of the market. So the goal today is basically to give you enough information so that you can sit down in front of a summertime market and give it a go, even if it's just on sim mode, to see if you're suited to it. And the key is basically we're going to use the characteristics of a summertime market to your advantage. Now, as per most of my webinars, I personally focus on the E-mini S&P futures market, so all of my examples are going to be based on that. Okay, so I'm going to presume first there's a few people here that are new to trading and haven't traded during the summertime yet. New traders that have yet to experience that particular delight. So let's first consider what's going to happen during this time. So first of all, people are going on holiday. So despite all the talk about markets being an HFT battleground, when people go on holiday, the volume drops dramatically. So it's possible that Robbie the trading robot actually goes for an oil change at this point, or it's possible that the markets are really driven by people after all. And these holidays generally last till the week of Labor Day, which is the first Monday in September. Now, things might pick up that week from Tuesday on, but really don't rely on the volume coming back in the market until the following week. Now, as we've discussed in previous BMT webinars, for markets to move, market orders must eat limit orders. So we've also discussed the fact that the amount of liquidity or limit orders in the market is one of the primary drivers of the personality of that particular market. And liquidity or limit orders have an inverse relationship with volatility. So if the liquidity in the market drops by 50%, we can expect it to be more volatile. And similarly, if these liquidity-eating market orders drop significantly, there will be less eating of limit orders or liquidity, and therefore there will be less volatility. And this is basically what happens in the summertime. The volume goes down, and interestingly, a lot of the time, the liquidity actually increases. We get more limit orders at each level. So that combination causes some very, very tight trading ranges that can last all day. Now, I know I've just used a bunch of terminology that will have possibly confused some people. If that's the case, just go back to the earlier webinars we did on BMT, the first one, Introduction to Order Flow, and we explained that terminology in very simple terms. So basically what's going to happen in the summertime, the markets will be slow, sometimes painfully slow, and with lower volatility, the markets are going to give up fewer ticks. There is less opportunity. Now, we've experienced some of the chop already this year in July. Now, we did start to pick up at the end of last week, and we had a kind of decent day this week, but basically we are kind of getting into that summertime chop mode already. So here is the typical sort of action we can expect. So here we are. This is July the 7th this year at 10:30 a.m. We're 1 hour into trading, and effectively what we've done, we've pushed down at the open, and then we've gone sideways for 30 minutes. Now, if you look at the volume traded at each price over here on the dome, this is excessive at each level. There's so much volume traded at each one of these prices. So the liquidity itself is not low. There's plenty of limit orders, and as we can see, those limit orders aren't pulling out of the way because we can see this volume. We can see this volume at each level. So they're actually absorbing contracts, so hence all the volume at these prices. So if the liquidity is lower, we would actually see more volatility, but it's not low at all. So this small range played out for about 30 minutes. And as you can see from the chart, it hit the extremes many times, probably more times than I can count actually. So we can see it then popped up and built a smaller range again before we dropped back down. So the total move for the first hour is 20 ticks. Now, another thing worth noting is we poked down through the overnight low, which is this blue line here, and we couldn't hold it. We then popped up through the lower extreme of Friday's range, and Friday was a half day, previous Friday, and then we rolled over. Now, on normal days, buyers would normally jump in on a rejection of the overnight low from above, and sellers would normally jump in on a rejection of yesterday's low from below. So whilst it's rangy, it is reacting to common levels, but not in the sense that it's going to initiate a new short-term trend. Now, on more normal days, you could have hit both of those levels in the first 30 minutes, and those two levels would normally be a lot further apart. Now, if we look up at the NQ is showing effectively the same things. We've got this lower range here, then this upper range here, then a fall back down. So while you're watching this sideways action, waiting for something to happen, there's other traders actually making gravy fading these extremes. So while you're there thinking nothing is happening in this market, other traders are pulling out ticks, and of course some are losing ticks. So it's kind of a case of one man's inaction is another man's action, and that's what we're going to look at today, is how to turn yourself into a trader that can take advantage of this type of action. Now, people new to this action, I've spoken to a lot of traders who said, I got chopped to bits today. I'm sure we've all heard that phrase, but they don't understand why. Now, many people get, as more experienced traders, they actually sit the summer days out. Certainly, it's a good time to go on holiday. I know I used to sit these days out. US markets open in my evening, so in the summertime, I basically turn on the screen, watch the first 30 minutes, and then just switch it off if it looked like another slow day. And as my trading developed, I started to pay more and more attention to the volume profile in my trading. So I guess it was a natural progression for me to try and kind of break the back of this summertime action. So one summertime, I basically decided to see if I could find an edge in this action. So basically at the start of the summertime, I sat down and said, I am going to watch this until I figure out how to trade it. And this is a trader that mostly relied on those kind of 8+ point intraday swings on the ES and entering on a retracement. So this is a very different kind of trading for me. And it turns out, actually, the summer isn't all bad news. So let's just consider the pros and cons of trading this chop. Okay, so the first thing you're going to see in the summertime is the markets are actually more predictable during the summer months. So even if you don't like the specific kind of action that you're seeing, you have to admit that most days in the summertime are fairly predictable. Okay, so you don't have to spend a lot of time deciding, okay, is the market going to trend today or is the market going to chop today? And when you trade a trend, you kind of apply the complete opposite approach to trading a range. So the kind of easiest trade in a trend is a pullback. But in a range, that same location is the middle of your range and where the highest volume is generally, or the POC. And with a range, the absolutely worst location to enter is in the middle of the range. So the best location on a trend entry, the pullback, is also the worst location on a range day. Now similarly, fading levels on a trend day is a pretty poor strategy, partly because on most days I do my you'll see my pre-market prep on BMT, and there's often 3 or 4 levels that I've got on there that an intraday move might reverse. But you don't really know which one it will be. So if you get run over a couple of times playing the closer levels, it leaves you playing catch up for most of the day. In addition, those levels are kind of rife for manipulation. So you have people specifically waiting at these levels that they know reversal traders are going to trade, waiting to push you out of position. So the worst trade on a day where we've got intraday trends, the fade, is actually the best trade on a ranging day, but the worst trade on a trend day. So in effect, range trading requires the opposite approach to trend trading, and on non-summer days, traders spend a lot of time trying to decide which mode, trend or range, we're currently in. So again, one advantage of the summertime is predictability. Now markets are going to slow down and speed up all the time, and if you traded through 2013, you will notice that you'll remember that it just slowed down just for no reason at various points in the year. Now if you learn to recognize these high volume at price, small volatility ranges and how to trade them, you can take advantage of them anytime they occur during the year. So when everyone else is saying, oh man, this market's rubbish, it's not giving me any ticks, you can actually be carefully picking off those ticks. So to me, the best reason to give at least one summer a go at trading, if it's not for you, you'll find out. But if it is for you, it gives you something you can actually use when volatility drops. And you can use that all year round. Now the other thing about a slower market is you've actually got more time to make a decision. The market's not likely to run against you 10 ticks in a heartbeat. Now of course news can make that happen anytime in any market, but generally speaking the market's going to be slower. It gives you more time to make a decision about both entering and managing a trade, both of which are key skills for this type of action. The slowing down is also going to reduce the risk when you're actively managing a trade. Now, also your maximum risk or your stop loss is going to be close to your entry point on these trades. Now, if that's confusing, by the actively managing a trade, I mean you can get out of break even sometimes if you don't like the action. So you don't have to wait for your stop to be hit in any market, but with this kind of slowdown, that post-entry action is something you have a lot more time to analyze. So you're going to be able to get out before your stop is hit when a trade's moving against you more often with this type of action. Now the market does still respect key levels, and as this is more of a faders market, playing those levels, at least for an initial bounce, is actually a higher probability in these markets. Now on the downside, the market will often trade a whole day without going near any level you've defined in your pre-market prep. So if you're waiting for levels to get hit, you could well wait all day and not see anything get hit. Now of course there's some downsides, so trades also have less potential rewards in these markets, and in some cases the range is basically going to be too small to trade. So personally, for me on the ES, I'm not going to get into a trade on the ES in a range bound market if I'm looking at less than 3 ticks profit, which means at least a 4-tick range, okay? And that's me personally, so don't let me put you off. If you watch this for a summer and you find you can consistently pull out high probability 2-tick trades, that's fantastic. But the reason I go for 3 ticks or more is that the impact of commissions is greater. So if you took this to an extreme and traded a range where you had a 1-tick stop and target and like a $4 commission, which is a typical retail commission on the ES, then every trade you win is going to make you $8.50 per contract, but every trade you lose is going to lose you $16.50 after commissions. So basically you need a win ratio of 66% just to break even. So this kind of trading should be higher win rate anyway, but needing 66% to break even is a bit too much to overcome. So you've got to think basically what's my win rate and what's kind of my minimum size trade I can actually do, because commissions are such a kind of a higher impact when you're trading for less ticks. Now you need to be patient. So if you're the guy that comes into the market heavily caffeinated at the start of the day, this might not be for you. So there's going to be a lot of times, especially if you follow the advice here, that you're going to put a limit order into the market, you're not going to get filled, and then you're going to see the market go 5 ticks your way without you. Okay, and you can't chase these trades, and we'll see a trade later that I didn't chase, even though it would have been right. Because basically, if you chase the trades and you get in halfway through the move, then the risk-reward and the commission thing kind of goes all screwy again on you. Now, you can rest limit orders at both extremes of a range, just basically regardless of anything else. You can just put your limit orders in and then focus on managing the trades once you're in. So that's a good idea in terms of getting a good queue position and being able to get out of break even, because there's often going to be people behind you in the queue. So if you want to actively manage the entry, as I do often, and by actively manage it, I mean wait till it gets to your price and then make a decision, trade or not, you're going to miss a lot of trades. So there is a trade-off between just resting limit orders at each side and actively working an entry. And you've got to be able to accept missing a trade. And if you do miss a trade because you put a limit in, it came to your price, traded, didn't fill you, and then did exactly what you thought it would do, the best thing to do is give yourself a big pat on the back for being right. Okay, so you're not going to make any money, but try not to let it kind of put you into a state where you're feeling like you've left out or you've missed out, and you need to kind of, now be more aggressive. Now, sim trading is a bit of a downside here, because there's going to be, as we see this, there's going to be a lot of reliance on getting filled on limit a lot of the time. And with Ninja, for instance, it's got 2 modes of filling on sim. One is unrealistically good, one is unrealistically bad. And it's not a fault of their product, but basically sim products were really never meant to be that accurate for fills. But I would say start off simming this initially. Don't go straight into live, but just take it, just understand that the fill part of the sim isn't going to be 100% accurate. Okay, so what we're going to do first is we're going to take a look at the components of the tools that can potentially help you on these days, and we're going to look at some screenshots of the 7th of July. So at this point, going into the market, because of what had happened the prior days in July, my presumption was we're in summertime chop already based on what had been happening earlier in the month. So let's first look at the components of the tools and at the same time show you examples of what to look for. Now, we have basically 2 main reasons and 2 sets of tools that we're going to look at today. So the first one we're going to look at is basically this thing here, which is known as reconstructed tape. And let's just kind of think about why that was created. Now, the CME, the lovely CME, they give us a level 1 feed, and that's what drives the time and sales. Now, before October 2009, the CME would give us 1 print on time and sales for every market order that got submitted. So if someone put in a 500 lot buy market order, then that would appear on time and sales as a green print with the number 500 against it. And remember, we're interested in big prints because market orders eat liquidity. Now, in October 2009, the CME changed the way this was reported. So now, we're going to see one print on time and sales for each limit order a market order is filled against. So in layman's terms, the CME splits up large trades so we can no longer see them. And this was actually done to give a more accurate picture of the market, because you can see all of the individual fills, okay? So it was kind of allegedly the CME trying to help us. So basically, when Mr. Big puts in a 500 lot buy market order and it gets filled against 500 one lot retail sell limit orders, you will see 500 one lot green prints on time and sales. Well, of course, you won't see that at all because you've probably only got room for 50 or 60 or so prints on your screen. So what you're going to see is a blur of green, 10 pages or whatever, and you won't know if that blur was 5 pages, 10 pages or 20 pages. So the first tool that was developed at the bottom right here is something we call reconstructed tape. Now we basically reconstruct those large market orders so we can see the original orders submitted instead of the fills. So on here we're going to see the one 500 lot print instead of the blur of 500 going past. Now as it turns out, seeing large size on your side is a great help, but when we developed this, I found it didn't help in the way I was expecting. Okay. Now obviously if you're in a trade, you want to see large size on your side. If the market pulls back, you want to see it pull back without too many large trades in the pullback. But as it turns out, and kind of unexpectedly for me, for helping you enter, what is far more interesting is stuck traders. Now if we look at this reconstructed tape here, what we can see, we've had kind of larger traders hitting into the bids and moving the market down. So we've got 73.25, 73, 72.75, 72.50, and we've got one here at 72.25. And so now here we are, we can see the price. We're at 72.25, 72, so bid 72, offer 72.25. It's 9:31, just come into the market. We can see the greens, large size, relatively few and far between. Okay, so we go forward a short while, and now we can see some large sell orders hitting into 72. Now at this point, we have to consider a piece of conventional wisdom that everybody knows about trading, and that conventional wisdom says, we all know most ES traders have 8 tick stops. Now that's what I've been told, and there's even some guy that keeps posting on my YouTube channel that I'm talking nonsense because everyone knows traders have 8 tick stops, so it must be true. Now I happen to know a guy that trades 500 lots at a time, not on the ES, on the treasuries. Now he's got very low commissions, and of course he doesn't use 8 tick stops. In fact, he's only looking for 1 tick target on his trades. Now that's not my game, but we need to consider the behavior of some of the people that are behind these large trades. Okay, so it's not like we can say that every large trade is a short-term scalper that's going to exit quickly if he can't get a fill. But we should be aware that these people exist and that they do react, as we all do when it looks like things aren't going our way. So that brings us to the point about these big guys. Here we are, 1 minute and 41 seconds into this market. We had a lot of trading at the open, and basically we can see this trading here at the open. The open's always pivotal on the ES. Basically the bulls couldn't hold this. We can see 3,900, 5,500 contracts here, and basically the sellers stepped in. Okay, and the sellers stepped in and they got some move for their selling, and they got it down to 72. Okay, so if you're a seller, you're feeling pretty good right now. We've got we've got 444 contracts here on the bid. So there's not a lot of bidders, not a lot of liquidity to eat to stop us ticking down some more and for the sellers to get some more love for their money. Okay, and then that takes us on a little bit longer. and we have to think, how do the sellers feel now? Okay, there's still not much liquidity. If we look at the inside bid here, we've got 337 contracts to eat. Okay, we have ticked down to 71.75 because we can see that 22 contracts sold there. It's not a huge amount. Okay, we can also see more large sell orders. Okay, so we've had this 100, 179, 250, and the result of that additional selling, well, absolutely nothing. Okay, so just from the perspective of this reconstructed tape showing trades of 100 contracts or more, we can see that sellers are no longer getting any price move down for their efforts. And what's going to occur at these key points is you're going to see a regular pace of sell, 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 tick down, sell, 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 tick down. Then you're going to see sell, 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 oh crap, and then buy, 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 buy. So there's an appreciable pause. Okay, you could just watch this single window here and get a feel for when those guys are trapped. And it's actually a good exercise in itself to do that. Just turn on big trades and watch the ebb and flow and watch it pause when they basically overcommit themselves and get caught outside. So anytime there is a pause like this, they could, of course, come back into the market and hit it with more sell market orders. But the longer the wait, the longer you see these guys here trapped without getting any movement, and no more of them coming in to move the market down, the more likely it is to snap back up in the short term. Okay. Now also, if the other side comes in and starts buying, obviously the sellers will see that and they will be like to move up. If it ticks down and can't stay down, like this 22 contracts here, or if there's an iceberg order against them, then the chance of fading this is better. And of course, in this case, we have the tick down, couldn't hold it, and we also have this thing called an iceberg here. Now, on the topic of fading, obviously this is in the context of an overall choppy, low volume market. So I'm not a fan of trying to catch the high or low of the day. So if this was after an 8-point move down, I wouldn't be looking to fade this. Okay, so watching these larger trades help this. You want them on your side when you're in a trade, and you want them trapped when you're entering. Now, just a couple of other things about this tool. As you can see, or you may be hearing my voice, I use something called LSD, or we call the least significance digits feature, to just show the important part of the price. So you can see here basically in my price, I see 72, 72.50, but you don't see the 19. We drop the 19, which makes it easier to read. And we also put a timer on how long the print's stay on the screen. So over here, I'm only looking at trades that occurred in the past 2 minutes. So trades that are older than that basically disappear off the bottom of the screen. Okay. We also have alerts and chart markers for exceptional trades. So I usually set that to 600 contracts, and then I've got a marker on the chart and also an audio alert when a particularly large trade occurs. So that's pretty much what I use that tool for on chop days. But this large selling isn't the only interesting thing that's going on here, and isn't the only thing that would tell you that this is where you should fade the market. Now, before I tell you what the other thing is, I'm going to tell you about this other screen here, depth and sales, and why it actually exists. Now, I was learning about order flow. I actually had lessons from other people. I talked to scalpers, I talked to prop traders, talked to a lot of guys who traded the order flow. And it became very clear to me when I was actually looking at what they did that I didn't have some of the mental skills that these guys had. Now, in particular, it seemed to me that anyone that could sit in front of the TT dome or CQG dome, as many prop traders do, and trade off it, were what I call mental acrobats. They've got a very, very good short-term memory for numbers. So they can remember how many trades hit into a level 5 minutes ago. They can remember what bids were sitting at a level and what offers were sitting at a level 5 minutes ago, and whether it's now increased or decreased. They could just do that in their head. Now, I couldn't do that. I'm just not wired that way. So I designed this screen to get over that need to be a mental acrobat. Now, these mental acrobatics, funnily enough, they're not even about making a decision to trade. Okay, it's purely about being able to read the data. So I figured if you took away the need to be a mental acrobat, it would kind of level the playing field in terms of being able to read the order flow. Now, of course, when you look at this screen, probably the first thing you're going to ask is, well, how did you make it easier to read when you actually added a bunch more numbers to the screen? And you might comment that there's no way I can read all those numbers at once. And you would, of course, be quite correct. There is no way you could read all this at once, and you aren't supposed to. So what I'm going to do now is I'm very quickly going to go through what's on there and what it is we can see right now that's making sellers especially nervous and why you've got a trade on. So first of all, look at these two columns that are kind of in the center. This here is showing something we call current trades. Now I presume you can all see my cursor over there. Can you just give me a Y if you can see my cursor?
Hey Pete, we can see it, but it's a little bit hard to see. There are some GoToWebinar drawing tools. You might try using those to mark up.
Okay, right. Okay. So, do you see the arrow? Okay, the arrow is probably better. Okay. So these columns here, they show something called current trades. So it's red here for sell market orders hitting the bid, and blue for buy market orders hitting the offer. And by current, we mean this time round. So these numbers are not cumulative. If we move away from a price and come back, these numbers will reset. And these numbers can also be reset. We've got some buttons up here that can actually reset those numbers. So when the market completes a swing low and starts moving back up, you can actually reset these numbers like I have here if we look at the previous slide. Okay, I didn't mean to do that. Okay, the previous slide. We can see, I'm lost now, sorry. Okay, if I look at the previous slides, we can see we had the data up there, and then we've cleared that data above. So basically, as you move back up, you're building numbers onto a blank canvas. So right now, we can see that we've got we've got 744 buy market orders that have hit the offer this time round, 1,801 sell market orders that have hit the bid this time round. So in terms of what to look at and when, these are the columns that I will focus on the most. So for me, if I'm sitting there watching the market, I actually like to watch those columns because they're actually moving all day. Okay, there's nothing static about them. So I don't go off and read email or browse the web. I will just sit there focused watching these numbers. Now, as we come into an area, a key area, or something changes in the way these two columns are acting, then of course I'm going to take a glance at the large trades and I'm going to take a glance at the other columns. So most of the time, all I'm watching are these two numbers. And that's me. Now, everybody has a different technique. I know people who primarily watch the depth on the dome. And reading the dome is no different from reading the price charts in that everybody's watching different things and everybody's taking triggers off different things, okay? So what I never tried to do with this was watch everything at the same time because we already know that I'm not a mental acrobat. Now, the next outside set of columns here, so the blue column here, these are the bids and these are the offers. And this is the liquidity that has to be eaten by those market orders. So right now we see 337 contracts at the bid and 366 contracts at the inside offer. Now looking down here, we can see more bids than offers, but at a low, that is to be expected and means very little. And that's kind of important when you're playing ranges. So we'll come back to that later. Now we can see that some of the bids are highlighted here because I set the bids and offers above 1,500 to be highlighted so that I know where the kind of larger bids and offers are. And that's basically it for the bids and offers. The next outside set of columns is something we call the snapshot. So this shows the total change so far in bids and offers since we last ticked up or down to a new bid offer level. Okay, so a positive number like this 1536 here means that 1536 contracts have been added to the inside bid. We look across here, 1098 contracts have also been added to the inside offer. Now, the other numbers here, like this -7, 7 appalled, that's kind of insignificant. So I normally filter out changes of less than 100 contracts. And I don't, as you can see, I'm only interested in the first 4 rows. I'm not really interested if somebody pulls an offer at 74 here. It's not really on my horizon, on my radar right now. Now the next outside set of columns here is the total trades at the bid and total trades at the offer. So this is kind of similar to current trades, although it never automatically resets. So these numbers just accumulate through the day unless you want to do a manual reset with these buttons up here. Okay, then we have the price. You can see the last traded price is highlighted. Then we have the volume profile. The orangey color is the value area for today. Yellow is the POC, or the highest volume price, and the white is the session VWAP. Now this column here shows your current order information, which is your quantity and position in the queue. And then finally we have this alert column, which is very simply a column for you to put notes in. So if you do your pre-market prep, you can see here from my pre-market prep, here was the overnight low. LIS, just a line in the sand. This is just stuff we can input manually. Now we said that something is making these sellers nervous. I'm sure a lot of you in the room can actually spot what that is already. Okay, so what we can see here is the bid is actually quite small. On the previous slide, the bid was 444 contracts, so it's actually down to 337 now. But 1,800 contracts have traded into that bid, so it's gone from 444 to 337, but we've had 1,800 trade. Okay, now that's only possible because they've added 1,536 contracts to the bid. So whilst the sellers have been selling all these contracts here into 72, some bidder has quietly been absorbing all that selling by adding to his bids as people traded into it. Now, when you keep the bid fairly low, which is what they're doing here, there's a chance that a sell order, a single sell order, or a couple of successive sell orders will exceed the size of your bid before you have time to refresh it. So basically, that's why we see this 22 down here. Okay, this 22, all it's saying is that sellers exceeded these bids for a moment. It kind of printed 71, 75 for 22 contracts, and then these bids at 22 refreshed again, and we tick back up. So basically, sellers are trapped by this thing, this refreshing, which is what we know as an iceberg order. Now, that alone doesn't give you a 100% guarantee that this level is going to hold, but it's a good entry for a couple of reasons. So first of all reason is you can join the bid. Okay, so sometimes when they do this refreshing, they'll actually be showing 1,500 contracts and refresh and stay at 1,500. So if you want to join the bid, if you want to add a limit order at 72 to buy, you've got 1,500 people in front of you that need to get filled before you do. Now in this case, they're keeping the bid around 300 or 400 contracts. So if you join this bid now, you need only 400 contracts to trade before you get filled. So that is a good position to be in. Now, if you look just below, there's 1,493 contracts bid at 71.75. So if you join the bid at 72, regardless of whether you're filled or not, if you see this 1493 suddenly reduce in size, you can cancel your order or you can get out of the trade because you know the bidders are possibly had enough and are now going to get out of the way. So if the bidders below you start to get out of the way, that reduces your chance of a successful trade. Okay? So you can do this before it even comes down to 71, 75. So just while it's here at 72, if you see all these bidders here start to pull out of the way, you can say, okay, forget about this trade. Okay? So if it does tick down again, so if we do tick down to 71, 75, as long as it stays there with like 600, 700 contracts, you can stay in the trade. So you could exit at a tick loss because the sellers start to chew into those bids. So if they start trading into it aggressively, you cut the trade. Now, of course, there's always a chance that we tick down 71.75. You see 800 bid, you say, right, I'm going to stay there because I still see 800 bid, and then suddenly somebody puts in a 900 tick sell market order, in which case you exit at 71.50, which incidentally, for a trade like this, is where I would put a stop loss. Okay, so you could be at a break even or one or two ticks loss, but it's a slow market, so you're going to actually have time to make these decisions. Now, the upside on a trade like this, well, potentially back to the high of the day, 73.75, or this area here at 73.25, where we've got this step in the profile. So that's kind of where you'd be looking at targeting. And the third reason this is actually a decent trade is because we're in the chop. We know it's a faders market. So if you're in a market you know is a faders market and you see this kind of thing, you've got a good chance that it's going to go back up. If it's not a faders market, this becomes a much lower probability trade. Okay, so this is not a good guaranteed trade, but it's a good probability. You've got sellers trapped. You've got an iceberg and bidders absorbing, so it's kind of a typical fade trade. Okay, so if I can get my slides down. Mike, I might need your help. It doesn't want me to go to the next slide now. I've got the pointer on.
You can, I think you hit escape and it'll go back to the default pointer.
Okay, got it. Brilliant. Thank you, Mike. Okay. Okay, so we're going to the next slide, and we're going to see that I didn't join the bids at 72. So joining the bids is one way you can play a range market. The other way you play the range market, the other entry, is basically buying into the offer as you think it's about to break. Okay, so it's a tick worse entry. Instead of taking this limit, joining this limit order at 72, at 72, you actually buy the offer at 72.25, and it's just a market order effectively. You're getting in a market one tick worse. Okay, now you do this because you think it's going to move up right now before giving you a fill at the bid. Okay, if you think that's going to happen, it's worth taking a shot because you should immediately see it tick up and be at break even. Okay, so if you see the buyers aggressively hitting in, or you start to see the offers pull out of the way, then regardless what's happening in the bid, it's about to tick up. Okay, so it doesn't guarantee that it's going to stay up either. It just means it's kind of tipping the odds in your favor. You've seen the sellers get trapped. You've seen the absorption. Now you're seeing the offers pull out of the way. You're not going to get a fill on the bid. I'm just going to hit in the offer. I want it to tick up straight away. Okay. Now what we can see is that after that happened, we actually get some, just before that happened, we actually had some big, fairly big buy market orders hitting in 72.25. So basically, we bid 72, offered 72.25, some big players hit into that, and basically it was that that initiated, okay, I'm not going to get filled on the bid, I'm going to have to hit into the offer. Okay. Now at this point, if I look at the bids behind me, there's only 59 bid behind me, and of course that's because it's just ticked up into an area there were no bids before. Okay, so it did trade against in this instance, but nothing hit in to 71.75. So we did come and tick down again, but we didn't make any headway, didn't come back down to this 71.75. So there's no reason to pull out of the way on this trade. Okay. Okay, and this is where we got to. Now we can see the reaction. We can see the last sellers here, the last guy that sold into 72, 250 contracts. We can see they had another little go here. But basically we're seeing the reaction we want to see on the tape. We can see 30 seconds later we've got all these buyers basically that came in and pushed the market up to 73. And we're only 30 seconds later. This is action right at the open. Okay, So we're now up 5 ticks from the entry point because some of those short-term sellers bailed out, and also because a lot of retail traders got stuck, and they exited and helped to drive the price up. So now we're back to the step in the profile and close to the open, so it's out of the long trade and in with the short to lean on the volume up there. Now, perhaps the hardest part of range trading is fading yourself, okay? So if you're in a long trade, it's very difficult to reverse and go short. I'm uncomfortable with it personally, and there's nothing wrong with just playing the range from one side only. But if you can play it from both sides, it does take a bit more mental effort. You're obviously going to make more money if you're playing both sides of the range. But right now, this isn't a range yet. You're going to say, yeah, but this isn't really a trading range yet. It's a slow market, okay? So I'm expecting a range to form, but because we're only 3 minutes in, I'm not sure where the range is going to be. But opportunity one was clearly stuck shorts in a faders market. This opportunity is slightly different, okay? This opportunity is seeing a step above us, which is basically steps in the profile quite often hold. But it's just below the open price, okay? Now, if you watch the ES and you regularly follow the action around the open price, you know it's an area that the buyers want to get above and the bears want to stay below, and you often see quite a little battle at this area. So basically what I'm doing here is I'm leaning on the step in the profile because I want the bears to step in and I want the open to hold. So basically I'm in at 73, I want 73.50 to hold, okay? I can see the buyers on the way up, but there's no pause yet. So this opportunity is a bit more tenuous because there's no order flow confirming this on entry. So this is effectively basically me just putting a limit order in where I think the market's going to go to reverse the trade. So this is me just fading myself. Now, in fact, because I know this was a more tenuous trade, I actually ended up scratching this trade because more buyers did step in and they kind of spooked me out of the trade. Now, those buyers didn't get any traction as it turned out, and I kicked myself on the way out because, as we'll see in the next slide, we can see this. Okay, so what we can see is these two large trades, this 105 and the large trades here hit into 73 after my entry. So it's those guys that spooked me out. Okay, so I saw them hitting in, but you can see after that only 18 contracts hitting 73.25. So my scratching that trade was more emotional than logical because I was kind of leaning on this open. I was saying I don't want the open to break, but I saw a couple of big traders in and just got out. Okay, so nobody wanted to hit into this 73.25 price. Should have stayed in, didn't. Okay, move on. Now what we have overall here is a failure to get to the open, and again I can't stress how important the open price is, especially when you're trading this kind of market. So we got buyers up to 73. These were followed by sellers down to 72.75. Now we have a couple of buyers hitting in 72.75, and what do we see? We can see 2,923 contracts hitting into 72.75, and it looks like those guys are trapped. Okay, now this isn't a good entry for me personally, because one of the things we said earlier on is entering in the middle of the range is not a good risk reward, generally speaking. So I have a personal rule against it, but the setup is there, and there are some other good things going for this trade. Okay, so while I didn't tell you this, I'm going to just tell you what's kind of on the plus side for this trade. Okay, first of all, the range here, or the profile, is kind of more well formed. It's kind of a bit more fat in the middle and kind of slimming out to the outside. It's not a perfectly formed profile, but any range you see that has kind of starting to develop a D-shaped profile where it's fat in the middle is a lot more reliable range. Okay, so it's fat in the middle, but it's only 2 points wide. Now when the range is only 2 points wide and we're this early into the market, there is a chance we can extend either side. So if I go short here, I could get lucky and possibly get to the overnight low, or this kind of line in the sand, this resistance area or support area I've identified down here. Now, that's the first thing that's going good about this trade potentially. The second thing is the offers. We've had 2,923 trade here. Look at the offer side. They're refreshing, but again, they're small. So we only need, if we get in and put an offer here, we only need 358 contracts to trade ahead of us before we start to get filled. So we can actually get in here at a good price. Okay? And of course, we're absorbing a lot of contracts, 2,900 contracts. So basically, we've got refreshing at the offer, relatively small offer. We could try and join this trade. Okay? Now your risk, well, nobody wanted to trade 73.25, and 73.50 is the open price. So if you get up through the open price, shorts are going to bail absolutely, and longs are going to start pushing it. But I would say your risk is this 73.25, this price we came up to. Nobody wanted to buy into that. So I'd say if they start trading into that aggressively when you get up there, then you're done. So downside target, though, are likely 72. Possibly the overnight low, and maybe this line in the sand here, but I think that would be pushing it on a summertime chop day. So for me, this was painful to watch. I scratched a short higher up, and then I see this kind of action here. That's a little bit painful for me to watch. But long term, it's been better for me to just let these things go. So if you miss the extreme, for me, I don't trade in the middle, but I can see there is an argument for taking that trade. Okay, and we can see where we got to. So basically, we did get to the overnight low. At this point, my wife has popped her head around the office door and asked me who I'm shouting rude names at. Now let's take a step back, okay? So we've just missed a trade, market's gone down. Do I want to rush into the next trade? Do I want to say, right, I'm at the bottom of the range, I'm going to fade it? Or do I want to take a step back, okay? And I suggest that we always take a step back and have a look where we are, because it's the summertime, we have time to make decisions, okay? So we progress down on the ES, we can see we're down to the overnight low. The NQ is moving sideways, but kind of towards, well, in the kind of middle of its range. The nicey tick here is down, but not an awful lot. We've extended our range down on the ES, okay, and it's now at the overnight low, and a couple of buyers have stepped in at 71.50. We still have these sellers down to 71.50 as well. They're still fairly new and fresh, not nervous yet. It's early in the day. I'm thinking this is one we should let play out a bit, okay? One of the reasons to let this play out a bit is we're at a key level, and there might be a little bit of nudging around at this price, okay? Also, the delta looks a little bit bearish at this point, so I'm going to just like let this play out a little bit. And in fact, if you're trading the summertime, it is actually better to just let the first 15 minutes play out, certainly when you start trading this. So if you wait 15 minutes and come back, you see generally you're getting a better idea of where the range is forming. So I'm thinking, okay, sit back, wait for 9:45. Okay, and here we are at 9:45. So now we can see, okay, range is kind of better developed. I can say, yeah, this now is giving me a better idea of where the range is. So 71 is the bottom of the range. 72.25 or 72.75 is the top of the range. They're both stepped effectively. Now there is potentially a downward bias. We can see, looking at the ES chart, we've got volume on the way down. We've got the cumulative delta is also down. I would much prefer this cumulative delta to be showing some sideways action. So right now, I'm looking at this. I can see where the range is. I want to play this range from the top down because I kind of feel it's more likely to break down before it breaks up, purely because of the cumulative delta. So it is fine to play both sides of a range, but at this point I'm just feeling that we've got a higher probability to play this range from the top. So that's not mandatory. You can be more aggressive with it, you can be cautious. I just prefer to be a bit cautious and try and cherry pick the best trades. Okay, so now let's fast forward a little bit to kind of where the end of the range is. So we're going to now look at this range breaking, and one of the keys of fading the range is being able to spot when the range is breaking. So as I said, you can just put limit orders in at the extremes of the range, okay, and then manage the trades after you get in. So there's no rule that says you have to see the ranges holding before you put an order in. So putting limit orders in earlier actually gets you a better queue position and leaves you with more people behind you in the queue, so you have more time for analysis after your entry. So here we are after at 10:07. You can just see all of the, we've got the extension up, extension down, then bounce, 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 bounce. Okay, and this is me about to get run over as we come out of the range. So if we look at the chart and the volume profile, we can see the range is narrowed, which is absolutely normal. So our focus now is 71.50 to 72.25, 4-tick range, 3 ticks available, but 4 ticks if you're really, 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 really lucky. And to be honest, I don't think it's viable to expect to get 4 ticks out of this. Now, the chart shows how many times we've hit the extremes of this range, and we've now got 116,000 contracts traded between 71.50 and 72.25. Now, obviously, a lot of the people that got in here have now got out, okay? Because we know this is scalper heaven, okay? So they're not. It's not as if all the people that got positioned there are still holding, okay? But this market is still like a coiled spring. The more people you have positioned here, the more the bigger the numbers in this range, the more the impact of them bailing out when the range fails. So on this, which is like the 7th hit or so, it's a less probable trade. Now, in normal conditions, if it's not summer, when a market reverts to a tight range, I'd be pretty reluctant to take the 4th hit. With summertime, you're going to get more hits, but you have to scale back or not trade the later hits, because the more times you hit the extreme of the range, the more chance you have of getting run over. So the only reason to take trades like this is the presumption that the market is slow and you can try to manage a good exit. So if you're like the proverbial deer in the headlights and you can't get trades, you shouldn't be playing this sort of action. Okay, so in this case, I've got an exit order in below because I want to get a decent queue position. I don't have that now. I want to get a decent queue position when it gets down there. And on the order entry, I'm at 323 in the queue, and there's 530. So like there's 200 people behind me. So if this sell order doesn't fill and moves down, I will actually let it fill this buy order below. So I don't really care at this point which way I'm going to get filled. I have less bias because the cumulative delta is a little bit more sideways, but also we can just see it's chopping sideways. There's no bias in this market anymore. Okay, so here I am, and I'm filled. Okay, and I'm filled at 72.25. Now I should be happy, right? Because I'm filled, and if I look at the large buyer side, I've only got 3 large buyers in the past 2 minutes. And if I look at the offers above, 1620, 2074, 1681, there's big, thick offers. Now actually there's a couple of issues with big offers like this. Okay, first of all, large offers almost always appear at the high of a range. And because 72.25 is effectively our range high right now, we're expecting large offers there. Okay, it's just a market phenomenon. It doesn't mean it will hold. Okay. Now, if you're wondering if you've defined the range correctly? Am I looking at the right price of the, for the range? It's actually this you use at confirmation that, yes, this is the high of the range. Everybody else is looking at this as the high of the range. Doesn't mean that the range will hold, but one of the downsides of big offers is this. Those offers are often there to fool you into going short. In which case, what you're likely to see, if these are spoof offers, you're likely to see some absorption on the bid side before it breaks, because if they're putting in offers to make you think the market's weak and make you sell, they're going to absorb your selling. Okay, so here I am. What I don't like about this right now is it's ticked up and the bids are firming, but also I've got a few of the offers at the inside offer that are pulling out in the way. Okay. Oh, great. Excuse me. Sorry about that, guys. Okay. Let me just get positioned again. Okay, so here I am. So I want to get out. Okay, I can see more of these offers up here are pulling out of the way. Now I put in a bid here at 72.25. Okay, so I've got a feeling this market's going against me, and I've just put in a bid to exit. So why not just exit with a buy market order up here and get out at 72.50? Okay, well, the reason is this is the summertime. It's slow. The markets are moving more slowly. There is more time to make a decision. So I can see the offers are pulling here, but I've got 869 still offered. So there's no reason right now to think that those offers are about to collapse entirely. So I'm hoping that a few more sellers see this size above and trade into 72.25, sell into 72.25 and fill me on my exit. So my fingers on the mouse, obviously 72.50 could break at any time, in which case I'm going to get out at 72.75, but because it's a slower market, I'm saying, okay, 869 there, on 546 in the queue, and they are adding to the bids. They've added 378 to the bids. I've got a fair chance of actually getting a fill on this one. And here we can see I've got the fill. So what we can see is 1037 trade into the bid at 72.25. Now, you might be thinking, I got out early again. Should I kick myself? Because I can see on the tape here, I've got these large sellers that sold into 72.25. Okay, well, if they sell some more into 72, yeah, I probably will kick myself. But right now, I had selling 72.25, but it's just this one guy here, this one poor guy here, sold one contract into 72. Okay, so right now I'm still happy with what I did. I'm still happy with the decision I made. Okay, now we can see the offers are pulling out of the way a little bit, and we've got some size that's come in on the bid side. So this is actually, so the buyers right now, if we look at the 880, 936, and we look at the tape here, we can see that the buyers are outnumbering the sellers, okay? So we're starting to pop a little bit. We've not popped yet. We're only 2 ticks above the top of the range, but we're starting to see the kind of action that is now going to make the sell side nervous. So we are starting to see the kind of action. So I kind of feel validated now that I made the right decision. And now what do we see? What we see here, 72.50, we're now seeing absorption at the top of the range on the bid side. Now, one of the key things about this is when you break out of a range, you often come back, and it's for reasons we've talked about in our previous webinars, you often come back to the top of the range and just sit there on top of it and can't get back to it. So we've got absorption at the top of the range on the bid side. Now this is actually a potential entry point for those that are a little bit more aggressive. So this is bidders trying not to let it fall back into the range. The sellers, we've still got sellers here playing the fade. We've still got these guys fading, so we've still got large sell orders into 72.50, hitting it and getting nowhere, and the bidders refreshing. Okay, so the sellers are getting trapped again. And then we pop up. Okay, so if eventually the sellers bail out, and we pop up, and we're now back at the open price, and we've got 1,542 contracts traded into the offer with 1,444 contracts added. Now the NQ has broken upside. The NQ is way past its open price, and what you're going to see on these kind of summertime chop days quite often is the ES is down, the NQ ups, the Dow is down, the Russell is up. You see kind of a lot of the correlations break down. We can see we've had a pop, but this is a range day. Okay, so we've had this pop. So what's our expectation? If we're saying this is a range day, we've now got some absorption, we've got some trapped buyers. What's going to happen now? So the options on a range day: one, we're going to fall back into the range. Two is we're going to extend the range, which basically is the same as falling back effectively. We're going to extend this range, we fall back, and then we start trading 71 to 73.50. Or we have a new range higher up. Okay, so at this point on a range bound day, your presumption, or my presumption, is this is a head fake. Okay, but if it is a head fake, it's the summertime, right? You're going to have time to let the market show its hand. Okay, so in any case, we're expecting more range bound behavior, but we just don't know if it's going to range again here or range against somewhere else. Okay, so we don't have to jump in straight away, because we know that the last range that formed ranged for 30 minutes. Okay, we are expecting multiple hits of the range. So this here is absolutely a perfectly valid fade trade, but again, given the characteristic of the summertime chop and the fact we're trying to take advantage of those characteristics, we're going to see how it plays out, and specifically how it reacts when it comes down to 72.50. Okay, so at this point in time, we've got a total range of 13 ticks, which is tiny. There have been some short-term opportunities for those that keep risk in check and are nimble getting in and out. Okay, and this is what a typical range day ends up looking like. So we have effectively two ranges here. The top to bottom, this is the 15th of July, top to bottom for the entire day is just 4 points. Now the first thing we can see is that the best opportunities are for the most patient. So we've got this kind of outer range here, okay? And remember, when we're looking at a range, you are expecting head fakes, so we do expect the head fakes either side, okay? But this is effectively our outer range, okay? And you can see how long you'd have to wait to take trades at that outer range. Now we also have these smaller consolidation zones that develop intraday, and these are the places that you can play for your 3 or 4 ticks. And this is what the summertime chop is basically all about, is knowing that these areas form, expecting them to develop, and actually playing them when they do. And like I say, it's not for everyone. The market can devolve into this sort of action at any time in the year, and it did constantly throughout 2013. So I'd say the main benefit here in being able to recognize this and play it is the fact that when the market slows down, you don't have to go and look for another market. You don't have to stop trading. You can actually trade this sort of action. Okay, so let's go over some of the ways that you can play the range. Okay, so the first of all is you do expect the range, but you've also got to keep a check on your market internals and your correlated markets, because they also should be showing low volatility. We've already said your correlated markets might not be correlated anymore, but they should certainly be correlated in terms of volatility. They might not go up and down at the same time, but volatility should be low on all. Now use the fact the market is slow to enter and exit. So it's often going to let you get out of break even. And because you're playing for fewer ticks, you have to take that advantage. So don't just get out of the market if there's a good chance you can work your way at that limit. So the market's going to be slower, and summertime trading is all about turning that to your advantage, entry, management, and exit. I would stay out initially of the ranges in the first 15 minutes. There is a lot of jostling for position in the first 15 minutes, especially around the open price. There are trades on, but they're not the easiest fades, because even though it's slow, it is a little bit faster. So I'd say when you first start doing this, don't bother with the first 15 minutes. Use the volume profile to tell you where the range is. It's where the most trades occur, not necessarily where the extremes are on the chart, and that is very important. And then secondary to that is use the bids and offers to confirm where the extremes are. Okay, so the bids are going to be high right at the range low, and the offers are going to be high at the range high. So that doesn't mean the level's going to hold. It just means the market perceives those prices as the current extremes. It's a form of consensus as to where the extremes are. Now, it's going to be normal to move 1 or 3 ticks through a range and head fake. This is range-bound behavior after all. So if you see it move through your range and then absorption 1 to 3 ticks through your range, it is likely to come back. So you could well have just gotten stopped out of a fade, see it move up 3 ticks, and then absorption. And you've got to try not to let the fact you've just been stopped out spook you out of playing the range trade when it moves up 3 more ticks. Now, the longer you play the range, more chance it has of breaking, and the smaller the size you should trade. Okay. The other thing is it's lower probability. The lowest probability trade is in the middle of the range, and that's where the highest volume is traded, and it's also where the market will slow down the most. So as you go through the middle of the range and where all the volume is, it's going to slow down, and sometimes just that slowdown will make you think there's an entry. It doesn't mean there's an entry. In fact, if you can't get through the middle of the range or the point of control of the range, and it comes back to your entry point without hitting the other side, be very careful, because that's the first sign often of the range fading. Now, market often breaks out of a small range, then moves and ranges elsewhere. So part of playing the ranges is to know that you're going to get caught out fading the range, possibly the last time. You know, that you're going to fade the range every time. Some people are very, very aggressive and just fade the range, fade the range, fade the range. You've got to then accept that when the range breaks, you're going to get taken out. Okay, so if you don't get caught on some of these breakouts, then to be honest, you're not trying hard enough. Okay, so that's just a cost of playing this type of action. Now, in terms of your entry, if you're entering on a limit order, you gain a tick on the entry. So that's a good thing, but sometimes you're just not going to get filled. So you can enter a limit order at either end of the range. That's going to give you a good queue position when price finally gets there. So if you're at queue position 50 and there's 1,200 in the queue, you can get filled, and if you don't like what happens, you can often get out a break even if they trade aggressively back into your entry price. So use the queue position. Okay? So there's nothing wrong with putting the orders in the extremes, letting them fill, use the order flow, the market internals, the correlated markets to kill or keep those trades. Now, to join limit orders, when price is already trading there, you really need an iceberg order with a small amount showing. So if you've got 300 or 400 contracts that keeps refreshing, you can join that. But if there's 2,000 showing there and you join it, you're probably not going to get a fill. It's just not going to happen. So watch for those two scenarios. Now, if you enter with a market order, you need to try and do it as the bid or offer you're hitting into looks like it's about to fail. So if you want to go long and the bid is 1,500 and the offer is 1,500, there's no point hitting into the offer just yet. But if you want to go long and the bid is 1,500 and the offer is like 200 and it's not refreshing, then the chances are, not a guarantee, but the chances are the offer will break first, okay, if you're at the range low in a faders market. Okay. Now, it also helps to see those negative numbers, the offer's actually pulling out of the way and the bid's refreshing on the other side. Now, obviously, whenever you enter the market, you've got to have a logical exit point. So if you go long and the bids, the 3 levels below you, are all 200 contracts, well, price is going to chew through that pretty quickly. So going long there doesn't make sense, because if it trades against you, any volume at all, those levels are going to break. But basically, you need a point to exit. And sometimes, because this is a faders market, that point to exit will be just below the low of the day, which common sense tells us that's where everyone has their stops. There's this thing about everybody has their stops below the low of the day, so your stop shouldn't be there. And I kind of agree with that, but sometimes it's just that's where the logical point is. So it's not ideal, but sometimes, yeah, your stop is going to be below the low of the day. But what you don't have to do is wait for the stop to get hit. Again, use this summertime slowness. Look to see if the bids start pulling close to your sell stop, you might want to get out before it hits your stop. Okay. Now, no range lasts forever, and it kind of almost makes no sense to discuss breakouts on range days, because they're the things that are going to happen least, because it's going to range so much. But when you do have a lot of positions in a small area, it generates energy for a breakout, and it is kind of important, even though you're going to get stopped out sometimes. You're going to fade the range and it's going to go against you. But it is kind of important to see signs that the extreme will break. So if you're looking to stay in a fade trade, obviously you've got to be able to try and learn to recognize to see when that range is breaking. So it's kind of a natural progression from fading the ranges to kind of getting involved with the breakout. So to play a breakout, you really need to get in at the extreme or before the extreme, simply because any breakout could be a head fake. Okay. Now the breakouts are without doubt the hardest trades to play on these days. So some of the things you need to see, it's good to see moving to your extreme, and as it's moving to your extreme, some sign that the extreme will break. So for example, as we move to the top, we come back and a large iceberg on the bid side with sellers stuck trying to sell in and fade the range. So seeing stuck traders at the top of the range, so maybe even initial bounce off the high that gets caught or stopped by an iceberg like we saw in the earlier slides, but also offers moving away as we get to the high. So if you see a lot of green, big buy market orders going up to the high, fast-paced, buy, 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 tick up, buy, 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 tick up, buy, 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 tick up into the high, and you see the offers pulling out of the way, that is a good sign the market will break. You've got buy-side momentum, you've got offers getting out of the way, and even better if behind you you have some big bids following you as you go up. Okay, you can get in on that trade, but that is a momentum trade, and it's literally a trade that you're saying right now, right here, right now, in the next few seconds, this market is going to break out. Okay, and if you slide back just 1 or 2 ticks, then your timing's off and you scratch the trade. Okay, so it's a very tough trade to get into because you really do need it to break right now, and you can get in when buyers are aggressively hitting it. But when they're doing that, it shouldn't slide back. It shouldn't stop, because the moment it stops, those guys that are hitting into it and have got that momentum will see that their momentum has faded. They might stop hitting into it. Now, you don't have to play the breakouts, but obviously, if you can tell when a breakout's happening, it's going to save you from some stop outs on your range trades. Now, in terms of cutting trades, you've got to be fairly aggressive at the start of a trade. Okay, so with cutting trades, you've got to say, right, when I'm entering, that's my highest risk period. The first few minutes after entry is my highest risk period, and you need to get out if you see some signs are going against you. So once in a trade, this is the summertime, and it does take time to get the opposite side. So my tendency is to get in, see, if I'm getting in long, I want to see the bids behind me are solid, see there's no absorption on the offer side against me, get a couple of ticks on side, and then forget about it, okay? Because it is the summertime, right? It's not going to get to the opposite side in 2 minutes, okay? So you've got to kind of, once you've got a couple of ticks on side, just let it run, okay? Now, there is an argument on range trading for getting out when momentum stops, okay? But it's the summertime, so to expect good momentum all the way to the opposite end of the range is probably expecting a bit too much. So basically, get into the trade, manage the first few minutes, get a couple of ticks on the side, and then just ignore the order flow, just ignore the action, just don't take any heat if it comes back. So that kind of brings us to an end, and as it says there, summertime trading is not for everyone. But as mentioned many times, markets slow down intermittently, so it's worth spending time one summer with this kind of new perspective I've given you, hopefully, just to see if you can use the pace and predictability of that market to your advantage. So that's me done. Thank you for listening. At this time, I'd like to open for questions. Mike?
Yeah, thanks, Pete. All right, guys, so as you have questions, you can go ahead and type them into the questions box, and we'll see what we can get answered. All right, John wants to know, does this approach work with treasuries?
Yeah, I mean, the thing is, this is the kind of thing that, this is the kind of action you see on treasuries more of the time. I don't trade treasuries, but absolutely, this is the kind of pace that treasuries sit off for quite a lot of the year.
Mike wants to know if JT levels are included in the tools.
JT levels is free, so I don't know if that's on BMT or not, but if it is, I've got a note. I'll put a note to put that on the webinar thread. Okay.
Velox wants to know, does your software report estimated position in Q for open eCry?
It does, yes.
MS wants to know, can you tell us more about the relevance of the open as the day progresses? You said that you don't want the open to break, so what's the reason for that?
Yeah, basically, if you watch it, basically, there's a tendency, it's the area that gets defended. Once you get to the open, you're back to zero. So below the open, you're in negative territory, and above it, you're in positive territory. So if you just watch as you get there and you watch the order flow at the open, you'll see it's an area that often gets defended. So basically, below the open, if we move down from the open and we move down 6 ticks, I know that above the open, the bears don't want it above the open, they'll defend it. But if it does go through the open, they'll start to unwind a little bit. So basically through the open, if I'm short and it goes through the open, I know it's going to start to accelerate, or I've got a feeling it's going to accelerate upwards. So that's the relevance. But it becomes less relevant as you go through the day. It's more the first hour or so.
Okay. Sam wants to know when this will be available for Sierra charts.
It's at the end of the year, Sam.
Okay. Velox wants to know, is the chart that you were showing available with Open eCry?
No, but I believe they have got a zigzag. So there's kind of the same, there's kind of one, but there's not. It doesn't have the swing volume and the number of ticks on it right now. Although it could be developed.
Bubba wants to know regarding treasuries, if your trading room is still open, and if you have a specific webinar that deals with treasuries.
No, we don't do it. I mean, we do have a trade room open, but it's ES. We don't do anything with treasuries. I mean, it's John Grady that does the treasury stuff. It's just not something I'm interested in trading. Even though I like trading in the summertime, I do like the ES when it moves in the year, and I'm just too, the treasuries are a bit too slow for me, basically.
Hal wants to know if it's a good idea to use these techniques after noon Eastern or when the liquidity dries up.
You know, I don't know, Hal, because I go to bed at noon Eastern because it's midnight here. I don't know. I mean, it's a good question. Does the lunchtime activity equal the summertime activity? I don't know. I've never tried. It's a very good question.
Okay, so Christopher wants to know about other markets, thinner markets in particular, like the NASDAQ or the DAX.
Chris, I don't trade them. I don't trade those markets, so it's not something I could really comment on.
Okay. David wants to know what exactly is coming through on the time and sales, and how does that interact with what's being shown on the DOM?
Yeah, basically, the time and sales shows the actual executions. The DOM is showing resting orders. You know, basically the DOM is saying, okay, I'm a resting order, I'm waiting for somebody to come and trade with me. And then the time and sales is showing the actual executions, the trades that took place.
Okay. Let's see. Velox is saying that I think he's talking about opening cry has zigzag, but without. I'm not sure. I think he means without the volume.
Yeah. Yeah.
So
okay.
Time to use NinjaTrader. All right.
Or change the OEC indicator.
Yep. Mike says, in terms of levels being respected in the summer and not the rest of the year, do you know the ratio of probabilities?
I don't do statistics. I'm a very discretionary trader, but it's just kind of a gut feel basically I'm giving you there.
Okay. Rusty wants to know when you determine if it's going to be a range day or a trend day. Okay,
usually if it's in the summertime, I decide before the market opens because that's what I think it's going to do. If it's in the the rest of the year, first of all I look at the VIX, but second of all the usual thing is if you watch the open trade, look at the volume and look at the range off the open, it's usually that opening. The first couple of minutes off the open gives you a hint, but usually by the time you're 15 minutes in, you've got a good idea if it's going to be a range. It's just kind of the pace of the market, the volume, and the liquidity, basically.
Okay. Al is asking, let's see, I think he says that he's using Sierra chart. Okay. I'm not really understanding the question. Basically, he says if a user wants to use Jigsaw for Sierra chart, which I thought you said is not available yet, should they buy now? Or okay, now I get it. He wants to know if he should buy it now, even though it's not available yet, or if the price is going to increase later.
No, it's not going to increase, Al. When we do new platforms, we don't put the price up, basically.
Okay. Velox wants to know what stop you use for this technique.
Well, usually the stop is where it's like finding that logical exit point. So usually like a 3-tick stop, but that's my worst case scenario. What I want to do is try and actively manage it and not take much of a stop at all, basically. So 3 is kind of my 3 or even 4 ticks if that's the logical exit point, basically.
Okay, Raymond's asking if you offer lifetime licenses for active order entry.
We don't know, I'm afraid, Raymond. Not right now.
Kurt wants to know if both of the, okay, on the right-hand side of the presentation, are both of those windows the reconstructed tape?
Yes, one was filtered showing trades above 100 and one was showing everything, basically.
Okay. Hal is asking if you have any word on the sessions issue with open cry, such as where the volume profile does not reset at the start of the regular trading hour session because open cry does not recognize the new session.
Yeah, basically, Hal, we're kind of resolving that, but it's part of a really major release for us, which is going to be the end of the year. So, yeah, we're working on it. Maybe OEC will come up with a solution first, but we're working on it, but it's the end of the year, basically.
Rusty says it looks like you're using a 600 tick chart instead of the usual 900 tick.
Yeah, basically when the market slows down a bit, I like to basically I use the number of ticks that show me like a morning's worth of action, and I found with the 900 it's kind of hiding a little bit, so I just drop down a little in the summertime, basically. Whatever looks like it makes sense.
Okay. Nestor wants to know if there's any discount codes.
Well, all the BMT Elite members get 10% off, basically.
Felix says if he's understood correctly, you normally use limit orders for the stop loss in a slower summer market to gain more time for the exit decision, and a market order stop loss when the market moves more quickly. Is that right? Yeah,
basically, if I'm in short, and I think the offers above me give me time to get out, then I'll put a limit order in. But if the offers are looking weak, I'll just get out a market order. Absolutely.
Okay. Ed says he's currently trading from the chart trader. Does he need a subscription for Jigsaw?
No, only if you enter the trades from Jigsaw. If you enter the trades anywhere else, you don't need a subscription.
Okay. Velox is asking if you're varying your size for each chop trade based on how strongly you feel about an individual trade.
Yeah, basically, yeah. Not really how strongly, but basically how many hits. So the more hits it's done, the more I think it's going to break, basically. Which I guess amounts to the same thing.
Okay. Well, Pete, so we're at an hour and a half, and it's you started this thing at like 3 in the morning, so at your time. So I guess now's a good time to stop it. And if anybody has further questions that they did not get answered, then your email is right there on the screen, peterdavies@jigsawtrading.com, or they can go to your website, jigsawtrading.com. There's also a thread on BMT. There's actually several threads on BMT that people could use to ask questions. All right.
Okay, well, thanks, and Mike, and thanks everybody for attending.
Thanks, Pete. Thanks, guys. Bye.
Yeah. Bye.